December 31st. As you read this, the people assuring you everything is fine are mistaken. Not because they're trying to deceive you, but because they're refusing to follow the math. While the public message stays calm, 14 specific indicators are flashing red. These are the same signals that appeared before the 2008 meltdown, the dot-com collapse in 2000, and the crash of 1929. And every one of them points to the same outcome: a major financial break is approaching. Not in 10 years, not in 5, but within 12 to 24 months, somewhere between mid-2026 and late 2027. The process has already started. The window is narrowing. And at this point, nothing can truly stop the unwind. It can only be postponed. You have about 18 months to get ready. 18 months to shift capital away from fragile assets. 18 months to cut leverage and reduce exposure. 18 months before the biggest wealth transfer since 2008 punishes the unprepared and rewards those who recognize the pattern early. This isn't guesswork. It isn't fear-mongering. It's mathematical inevitability. And once you recognize the cycle that has repeated for the past century, you'll understand why this crash isn't merely possible, it's extremely likely under these conditions. Right now, the U.S. economy is in the late phase of the longest expansion cycle in modern history. The bull market that began in March 2009 is now entering its 16th year. Historically, expansion cycles tend to last 5 to 7 years. The longest cycle before this stretched to 10 years during the 1990s and ended with the dot-com bust. This cycle has surpassed that by more than half. We are roughly 6 years beyond the historical average. But crashes don't happen simply because time passes. They happen because conditions form clear, measurable mathematical conditions that create structural instability. And every major crash in history follows a consistent 4-stage sequence. Stage 1 is widespread optimism and rising asset prices. Stage 2 is when warning signals appear and are repeatedly dismissed. Stage 3 is a trigger event that reveals how fragile the system has become. Stage 4 is a cascading collapse as forced selling feeds a self-reinforcing downward spiral. We are firmly in Stage 2. The warning indicators are loud, yet just like 1929, 2000, and 2008, they're being brushed aside by the very people who should be taking them seriously. History shows this pattern again and again. Let me walk you through 3 examples across nearly 100 years, because the structure doesn't change. In 1929, the Roaring Twenties were at their peak. The stock market had surged nearly 400% in under a decade. New technologies, automobiles, radio, electricity were reshaping society. Optimism was everywhere. People were buying stocks, and more of them were buying on margin, borrowing money to magnify gains. Margin debt reached 12% of GDP. But underneath the boom, warning signs were stacking up. Agricultural prices had been falling since 1926. Consumer debt was at record highs. The yield curve inverted in 1928, a signal that repeatedly shows up before recession. Commercial real estate in Florida had already crashed in 1926 after a huge bubble. Bank lending became increasingly speculative. Economists kept saying conditions were stable. Irving Fisher, one of the most respected economists in America, declared in September 1929 that stock prices had reached what looked like a permanently high plateau. 1 month later, October 24, 1929, Black Thursday arrived. The market plunged 11% in a single day. By October 29th, Black Tuesday, it dropped another 12%. Over the next 3 years, prices kept sliding. By July 1932, the Dow Jones was down 89% from its peak. Roughly $30 billion in market value vanished. About 9,000 banks failed. Unemployment reached 25%. Industrial production was cut in half. The warning signs were visible, but experts waved them away. Investors brushed them off. And millions lost everything because they truly believed this time was different. Now fast forward to 2000. The dot-com frenzy convinced an entire generation that the old rules no longer mattered. The internet seemed to be rewriting reality. Companies with no profits were valued in the billions based purely on promise. The Nasdaq surged about 400% in only 5 years, rising from around 1,000 in 1995 to over 5,000 by March 2000. Day traders were leaving jobs to trade full-time. The mood was the same, this time is different. Yet warning signs were piling up. The yield curve inverted in 2000. Corporate debt was at record highs. Margin debt climbed to about 2.7% of GDP, the highest level since 1929. Tech stocks traded at 100 times earnings or more, and many had no earnings at all. The Federal Reserve lifted rates from 4.75% to 6.5% by May 2000. Wall Street analysts argued valuations didn't matter in the so-called new economy, and traditional metrics were treated as obsolete. Then on March 10, 2000, the Nasdaq topped out at roughly 5,048. By October 2002, it had fallen 78% to around 1,114. About $5 trillion in market value was wiped out. Retirement accounts were cut in half. Hundreds of dot-com companies collapsed. The warning signs were there, but experts dismissed them, and millions lost fortunes because they believed this time was different. Now to 2008. The housing boom had convinced Americans that real estate only moves upward. From 2000 to 2006, national home prices roughly doubled. Buying property became the safe path to wealth. And more buyers relied on subprime mortgages. No down payment, no income verification, no assets. Banks loved the model because they didn't keep the mortgages. They originated loans and quickly sold them to investment banks, which bundled thousands into mortgage-backed securities. Everyone collected fees at every step. But by 2006, warning lights were flashing. Housing starts peaked and began declining. Mortgage defaults started rising in early 2007. The yield curve inverted in 2006. Consumer debt hit record levels. Major financial institutions were leveraged around 30-1, meaning a 3% loss could wipe out their equity. Ben Bernanke said in 2007 that subprime issues would be contained. Treasury Secretary Hank Paulson said the financial system was sound. They were wrong. Then on September 15, 2008, Lehman Brothers collapsed into bankruptcy. Credit markets froze. The S&P 500 fell 57% from peak to trough. $11 trillion in household wealth disappeared. Unemployment jumped to 10%. Nearly 9 million jobs were lost. The warning signs were there. Experts dismissed them, and millions lost everything. 3 crashes, 3 different decades, but the same pattern every time. Extreme valuations, easy money, rising debt, and warning signals flashing. Yet you still hear the same line, this time is different, and there won't be a collapse. Now look at today, December 2025. The total U.S. stock market is valued at roughly $60 trillion, while U.S. GDP is about $26 trillion. That puts the Buffett indicator near 230%. The long-term average is about 100%. This indicator peaked around 148% in 2000 before the dot-com crash. It peaked near 105% in 2007 before 2008. Today it sits around 230%. That's why many would call this one of the most stretched markets on record. The Shiller-Cape ratio is near 39, while the historical average is 17. The ratio peaked around 44 in December 1999 before the dot-com bust, and around 27 in October 2007 before the 2008 crisis. Now it's near 39 again, meaning stocks are priced at well over double their historical fair value. Margin debt is still hovering near historic highs, roughly $800 billion, close to 3% of GDP. There are only 3 other periods when margin debt reached similar levels, 1929, 2000, and 2007. Each time it was followed by a major crash. When prices fall, brokers issue margin calls, forcing investors to sell. That selling pushes prices lower, triggering more margin calls, forcing even more selling, a self-feeding spiral. Corporate debt has climbed to roughly $14 trillion, close to 50% of GDP. The historical average is closer to 35%. A large portion of this debt was issued in 2020 and 2021 at about 2 or 3% interest. That debt is now maturing and must be refinanced around 5 to 6%. That can double or even triple interest expense. A company paying $60 million per year in interest could suddenly be paying $180 million and extra $120 million coming straight out of earnings. Prices eventually have to adjust downward, but they haven't yet. Commercial real estate continues to weaken. Office vacancy rates remain roughly between 20 and 30%. Property values have dropped about 40 to 60% from their 2021 peaks. A building worth $200 million in 2021 might be worth only $100 million today, while still carrying a $150 million mortgage underwater by $50 million. And roughly $1.5 trillion in commercial real estate loans mature between now and 2027. When those loans come due, borrowers must refinance or repay. Banks won't refinance properties that are deeply underwater, which increases defaults. Those defaults hit regional banks hardest. Regional banks remain heavily exposed despite the interventions in 2023. From March to May 2023, 3 major banks collapsed: Silicon Valley Bank, Signature Bank, and First Republic. The panic was contained only because the Federal Reserve stepped in with emergency lending, but the underlying exposure didn't disappear. Regional banks hold approximately $1.3 trillion in commercial real estate loans that are deteriorating. When losses are recognized, capital can be wiped out, triggering more failures and renewed bank run risk, the same kind of dynamic seen in 2008. Consumer debt is now above $18 trillion. Credit card debt exceeds $1.2 trillion at average interest rates near 22%. Auto loan debt is over $1.6 trillion. Student loan debt remains around $1.77 trillion. Delinquencies are rising across categories. Credit card delinquencies have climbed from about 2.1% in 2021 to over 3.2% by late 2025. Around 3.2% by late 2025. When consumers are over-leveraged and delinquencies rise, lenders tighten credit and households cut spending. Both reduce economic activity and increase recession risk. The personal savings rate has dropped from roughly 16% during the COVID stimulus period to about 4% by late 2025. The historical average is closer to 9%. That means many households have little to no financial cushion. When layoffs arrive, they have no reserves. They quickly fall behind on debt payments, default, and pull back spending, which can accelerate the downturn. Unemployment has quietly increased from about 3.4% in early 2023 to around 4.5% by late 2025. That's roughly a 1.1 percentage point rise. The SOM rule says that when unemployment rises by at least 0.5 percentage points from its low, it signals a recession has begun. By that framework, the threshold was crossed months ago. The SOM rule has a strong historical record since 1970, and under this reading, the economy isn't merely heading toward recession, it's already entering the early phase. Manufacturing has stayed in contraction for much of the past 2 years. The ISM Manufacturing Index has been below 50 for most months since early 2023. Manufacturing downturns often lead broader recessions by roughly 6 to 12 months, so this signal suggests weakness is already embedded in the system. Leading economic indicators have fallen for more than 20 consecutive months through late 2025. That's described as the longest uninterrupted decline since 2007 to 2008. Because the leading economic index is designed to anticipate recessions about 6 to 12 months ahead, a run of declines this long is a loud warning sign, even as markets remain near all-time highs. The Federal Reserve is boxed in. After raising rates from 0 to about 5.5%, it has cut back to around 4.5% by late 2025. If rates are reduced too quickly, inflation can reaccelerate. If rates stay high, they can intensify the recession pressure building underneath. Either direction involves pain. Under this view, the Fed isn't preventing a crash, it's mainly influencing the timing. Geopolitical risk is still elevated. U.S.-China tensions over Taiwan, the war in Ukraine, and conflicts in the Middle East could each escalate into a shock that ripples through the financial system. In a highly leveraged system with stretched valuations, almost any major shock can become the trigger. The precise trigger matters less than the fragility of the system itself. These 14 indicators aren't presented as forecasts. They're framed as current conditions, observable facts, and the claim is that all 14 are flashing red at once. Based on historical patterns, the projected timeline is laid out like this through Q1 2026. Markets stay elevated and optimism holds despite weakening fundamentals. Corporate earnings miss expectations. Defaults rise in commercial real estate and corporate debt. By Q2 2026, stress becomes visible. A trigger event occurs, possibly a major bankruptcy, a bank failure, a geopolitical shock, or a derivatives blow-up. Credit tightens. Stock prices fall roughly 15 to 20%. Forced selling begins. By Q3 2026, the cascade accelerates. The S&P 500 drops another 20 to 25%. That puts the market down roughly 35 to 45% from the peak. Hedge funds fail. Retail investors panic sell. Unemployment rises toward 7%. Consumer spending contracts sharply. By Q4 2026, the bottom is reached. The S&P 500 is described as falling to somewhere between 2,700 and 3,500, a total decline of roughly 50 to 60%. Trillions in wealth are wiped out. Unemployment tops out somewhere between 8 and 9%. The Federal Reserve cuts rates back to 0 and restarts quantitative easing. The crash has largely played itself out. In 2027, the recovery begins slowly. Early investors who protected capital can generate exceptional returns, while many who ignored the warnings and sold near the bottom never fully recover. Their retirement plans are permanently damaged. This isn't a guess, it's framed as math. The S&P 500 is trading around 6,900. The historical average CAPE ratio is 17, while the current ratio is 39. To return to the long-term average, prices would need to fall about 56% from roughly 6,900 to about 3,000. The claim is that valuations always mean revert, and that this reversion is unavoidable over time. The Buffett indicator is placed near 230% of GDP. The historical average is around 100%. To revert to that average, total market capitalization would need to drop about 57% from roughly 60 trillion to 26 trillion. At the same time, corporate debt servicing costs are surging as low-rate debt is refinanced at roughly triple the rate. That translates into hundreds of billions in extra annual interest expense. And because that money comes out of earnings, the argument is that earnings must fall, and if earnings fall, prices must fall with them. Commercial real estate adds another pressure point. About 1.5 trillion in commercial real estate loans mature over the next 24 months. Many buildings are valued 40 to 60% below their loan amounts. Expected losses are described as exceeding $600 billion. Under this view, banks either face insolvency or require bailouts. This is positioned not as speculation, but as arithmetic. The debt exists, the rates are higher, and the losses are coming. From this perspective, the crash begins within 12 to 18 months. By late 2026, a bottom is reached. By early 2027, recovery begins. But the damage to anyone unprepared is described as permanent. The difference between those who are wiped out and those who survive isn't intelligence, it's preparation and recognizing the pattern before it finishes. You have roughly 18 months. The comparison to 2008 is used as the warning. In January 2008, the S&P 500 was around 1,410. Investors who reduced equity exposure raised cash and shifted into treasuries, and gold preserved capital. By March 2009, the market hit about 680, down 51%. Those who prepared early could buy near the bottom, while those who trusted the optimists lost about half their wealth. So the challenge is direct. If someone had told you in January 2008 that a crash was 9 months away, would you have acted? The claim here is that you're being told right now the crash is 12 to 18 months away, with clearer indicators than in 2008, more extreme valuations and higher debt levels. The conclusion is to act accordingly because the crash is described as coming with mathematical certainty. The final message repeats the core premise. The same 14 indicators that preceded every crash since 1929 are said to be flashing red at the same time. Valuations are portrayed as unsustainable debt as unpayable, and the system as over-leveraged. When it breaks, the unwind is described as violent, fast, and unforgiving. You have 18 months to prepare, 18 months to reduce risk and build reserves before the largest wealth transfer since 2008 separates the prepared from the unprepared. The timeline is presented as fixed. The crash is treated as inevitable, with the only remaining question being whether you're ready. If the warning signs are clear, and if you accept the mathematical limits of current valuations, the call to action is now. You have 18 months, and the window is closing. This is not financial advice. It's framed as research data highlighting a pattern that has repeated for more than a century and is claimed to be repeating again right now. Understanding that pattern is presented as the first step to surviving what comes next.